investor doing things on your own? How about someone working with a firm that isn't so responsive or in sync with your investment philosophy? My podcast talks you through all things financial. Look, there's stuff you don't deal with very often, but investments, insurance, and retirement is something we plan for each and every day. This is the Pennywise Financial Podcast, and welcome to the show. All right, welcome to the Pennywise Financial Podcast. Constantine here at Monarch Wealth Management, episode 123, season 8. Here we are in beautiful upstate New York, and it's good to be back. We had a couple weeks ago an episode with a beekeeper, and we've done some things with other guests in the past that have been, we've had some great feedback from clients, so we appreciate that, and kudos to those who do make it on the show and appear to share their wealth of knowledge. We don't obviously do everything for our clients. We do the best we can, but when it comes to things like legal, tax, etc., we obviously collaborate, but we don't do those things here at the firm. Let's start off with a few things to check on. We look at the wallet check for all of us listeners at home. The gas prices, about $4.50 a gallon, so about $4.50 a gallon. National average kind of hovering, goes up and down, maybe 10 or 20 cents, depending on which way the wind is blowing or the turmoil in Iran is happening and developing hour by hour. Gallon of milk, just under $4. Carton of eggs, $4.50. And the summer electric bill averaging $7.92. We'll talk a little bit more about that. That is not a promising number. Almost $800 a month in the summer for an electric bill. Obviously, with the temps going up and air conditioning running, that's not a good sign for a lot of folks. Electric cost spike, obviously 10+% in these times when people are looking to find some cooling and some resilience to this heat. Macro labor indices, we've got some headline CPI. About 4.25% year over year. Unemployment rate hovering just about 4%, and some job growth in June. 57,000 jobs that went up, and then leisure and hospitality down about 61,000. 10-year Treasury hovering around 4.5%. And then how about commodities? My son loves gold and silver lately. He wants to go to the jewelry store. Just had a birthday and wanted a gold chain. Just a mere $4,000 for this chain that he happened to pick out. Needless to say, he's not wearing that chain around his neck, but we did find something that I think satisfies his appetite. U.S. dollar, we look at that. Trading pretty strong. How about the price of gold per ounce? $4,700 in change, and silver at $85. Silver has taken a back seat and kind of slipped quite a bit this year so far, the first 6 months plus. Oil, $109 a barrel, and Bitcoin hovering about 60,000. So again, that's a snapshot of some of the things that are more important on our dashboard. And welcome to the show. A couple things to note. We do have a special birthday today. That is going out to, big shout out to Dave Georgiev, one of the founding partners here, wealth advisor. Dave Georgiev, if you see him today, please recognize him and remind him to have a great and happy birthday. Another thing that just happened, we are now month 7. So we've just surpassed halfway point through the year. And we have our newsletter that was distributed to those folks who like to get the paper copy, a hard copy. I prefer that version myself, even though I'm a tech guy. But we also have another version that went out electronically for those folks. If you're looking to get that to your inbox, just hop on our website, monarchwealthmanagement.com, shoot us an email, and we'll get you signed up. Now let's take a deep dive here into kind of the mid-year point. I know a lot of people have questions. School is out. Kids are enjoying summer activities, whether it be camp or looking for things to do, some fun stuff. But it's also a time for a lot of parents, a lot of folks that might typically be in the normal hustle and bustle of work and school to take a look at their finances and say, geez, do I have enough life insurance? Is my estate plan all put together? How am I doing with investments? We're halfway through the year. I'm up 5%, I'm up 10%, I'm up 20%, or I'm flat. What can I do to improve things, enhance things? So those are some things that I know people have questions about. I put out a blog halfway there that went out a couple days ago. I know a lot of people have questions about that. Geez, I'm up so far this year. Am I too late? Is there anything else I should be doing? Great questions. Great questions. And I think it's all relative depending on where you are and what your goals are, your time horizon, your appetite for risk, and your overall goals, what you're trying to do. So we're going to try to tackle all those things today. So let's take a deeper dive. The March hangover. If you remember the first few months in the year were not good months. Things started off okay, but by the time March came around, people were getting worried. People were concerned. Market was down, wondering if it was going to continue that way. So quarter one market sell-off was not a good place to be. But if you allowed that fear to control the way that you invested, you made some mistakes. Now our clients, 99%, I'd say almost 100, I can't say that for sure, but just about the entire firm's client base remained poised. We remained focused, right? And that's really what we do here as advisors. It's not just the stock selection or the mutual fund or the ETF selection. Choosing those investments is important, but it's following that goal, that guideline, that financial plan that we've developed over time and that changes. Explaining how the easy money kind of shifted a little bit. I saw gold up, Bitcoin struggling at 60,000, and then obviously the appetite for risk, and that's changed quite a bit coming from that March low in the market. If you got out, you missed quite a run on the market. Summer cooling, we talked about that, the utility trap there. $792 is the average residential summer electric bill. That seems very, very steep. My neck of the woods, upstate New York, yeah, we get some hot and muggy days, maybe 70s, 80s. But I'd say my bill is averaging around $350, $400. Of course, depends on the size of your home, how many people you have in the house. You're leaving lights on and windows open, doors open, air conditioning on. I'm kind of a stickler about that stuff at my own house. I was instilled in me when I was a kid, and it just never went away. So if we look at these summer prices, obviously we can see that things are going up. And the average reading in homes, we look at that, $792, coming from just under $200 in January. So these costs have been going up for a number of months, but you started to see things go up exponentially beginning in May. Of course, the cost and demand going up as well in tandem. So keep an eye on those windows, doors, and settings for all of your home needs to help reduce those costs. How about the employment numbers? Employment mirage and the World Cup hangover. U.S. is now eliminated. I know a lot of people are watching kind of from afar. I don't really watch a lot of soccer myself, but World Cup is on. You want to take a glance at least some highlights and some scores. How about the June jobs report? 57,000 jobs versus the expectation of over 100,000. So that might seem like a far cry from where we were kind of expecting things to go. But I think the divergence there is something we have to look at. U.S. hosted a massive World Cup. Obviously, the leisure and hospitality sector immediately shed 61,000 in June. Geez, you might say, how did that happen? Obviously, the temporary event-driven hiring collapsed, and the underlying corporate demand is cooling. Unemployment is creeping up to 4+%. But again, I wrote a blog about this. I don't think it's all bad news. I think we have to keep things into perspective. You see that number there, 129,000. It's a 72,000 job drop month over month there as momentum stalls, going from 129,000 down to 57,000. Expectation consensus was about double that, around 100 and change. Again, I don't think that's all bad news. I think it's going to be a change in what type of work people are doing. I've said this many, many times with the inclusion there of AI and faster, better, different ways to do things, remedial tasks, chores, things that we don't like and enjoy doing. A robot, an AI, an algorithm is going to be doing those things for us, I think, to help enhance and improve things so that we can focus on other things that we should be spending time on. So I think that's important to note. Now, as we sit here mid-year, what's our playbook look like? Well, I think, a lot of people might ask the question, and I think it's a relevant question. Geez, I'm up 10%. I'm in line with the market. Shouldn't I just sell? I mean, that's what I expect to get. Shouldn't I just sell right now, sit on the sidelines? Why risk it? I've already made my 10%. So if your target return is 10% year over year on average over the life of your portfolio, while you're allowing your accounts to grow, if you sell out at 10%, what if the market continues to rally another 10 or 15? You missed out on that. And then when you jump back in, when prices are high, so now not only did you miss the upside of the market, you're buying in at a higher cost, higher premium there. I mean, we don't like to buy things when they're not on sale. I wouldn't say that things are on sale by any means. However, I do think the trajectory, the momentum there will continue throughout the year. Now, it doesn't mean it's not going to be volatile, because every other session I feel like the market's up or down 2 or 3%. So you got to be a little cautious. Sometimes people might want to open the app and sell everything and go to cash and delete the app and uninstall and do all those crazy things. But the reality is, when there are questions, having a meaningful conversation and making some rational decisions based on your game plan and your financial plan that you've developed, I think is the best choice. That's proven time and time again. How about the energy tax? We look at some things like time of use arbitrage. Obviously, we want to take a look at utilities. I mentioned things, think of like laundry, pool pumps, dishwashers. That I don't have a pool. If I did have a pool, I'm sure my bill would be higher, much higher. And so those are some of the things that you want to keep in mind. Budget billing. Again, some people like this. Some people like the normalcy of knowing they're going to pay $400 a month throughout the year, and then they might have a little bill at the end of the year if they haven't paid enough. I have not opted for that budget billing, but you see that staggering number, $792. If you're paying that bill, that's a steep increase. How about the debt and career protection? I think of people's spending. You certainly you want to live within your means, right? So that's some of the things you can do as far as budgeting. With hiring slowing down to 57,000, employers obviously are going to continue to be very selective in what they're hiring for, right? It's not the summer to coast or make erratic career demands. I don't think so. Right now, it seems as though people looking for jobs kind of have the underhand at this point. We want to take a look at resumes, right? So if you're out there shopping for a job and on the market, maybe taking advantage of some of the services that are out there. I think, I've had some clients that are making career moves or changes. I would not take those choices lightly, like anything else, but this is certainly not the time where you have the upper hand. Another thing we like to do is, if a client or prospect or listener has questions, certainly reach out to us, and we'd be happy to address those questions, right? Take a look at things. So I do have some that come in through either email or direct to the podcast. So this one here is a 61-year-old, and they want to know, what is a super catch-up rule that I've been hearing from my friends? Okay. Well, obviously, there are some changes that happen year after year. This one applies to the Secure Act 2.0. Guidelines take effect this year. So in this case, you're 61 years old. This is Nancy. It doesn't say where this question came from, but 61 years old, you're going to be in the category of age 60 to 63. you qualify for an enhanced 401k or 403b catch-up with a limit up to $11,250. That's for this year, 2026. Yeah, that's up quite a bit, right, from the standard catch-up. Now, if you max out plus the catch-up, the super catch-up if you call it that, you can shield a massive $35,750 from taxes. And think about that for just a minute. You can shield or shelter those that portion of your income from taxes, have that money invest and grow. Later on, when you pull that money out, it will be taxable at ordinary income. So I think that's the next question. It's not just how much can I save in tax today. Everyone's a little different. Are you married? Filing jointly? Are you single? What's your timeline for retirement? What does your income look like in retirement? Or what do you project it to look like? Of course, we don't know what the tax code will be at that time, but we want to get an idea. Maybe a portion of that should go into a Roth or post-tax, where it does not help you today. Something else to think about. So I hope that answers your question about the amount. And if you qualify, the answer is yes to both. And should that money be pre-tax or post-tax? Well, I don't know. I think we need to get a meeting to find out more. Another question. Why did my ACA health insurance premium just skyrocket out of nowhere? I just heard about this on a recent podcast I listened to. So healthcare premiums, right? I can tell you my healthcare premiums are out of control. I have a high deductible plan, and when my premiums are more than my mortgage, there's an issue. Now, I'm not complaining. This is not a pity party or story asking for help. I realize I'm self-employed. I made some life choices when I embarked on this voyage over a decade ago. I've grown to become comfortable with the cost of healthcare, and I know a lot of others are in the same boat. But it doesn't mean that it's not broken. It's not a broken system. And I don't have the answer. I don't know that we have a better system to shift to, but when premiums are that high, it's quite a bit. Well, there's something called the subsidy cliff, right? You may have heard of that. So some of these premiums were subsidized. And then we've had the expanded premium tax credits that kept the ACA insurance incredibly cheap, right? And that happened over the last several years. But those expired at the end of 2025. So this year, in 2026, if your Maggie from The Simpsons, modified adjusted gross income crosses even $1 over 400% of the federal poverty level, your government subsidies drop to zero, nothing. You get zero support for that if you're over 400% of the poverty level. You got to meticulously manage your pre-tax deductions. Again, when we talk about should I put my money into pre-tax or post-tax, well, there's a lot of different questions that come about. I have some retired folks that might qualify for subsidies, right? Some are income-based, some are asset-based, some are a combination, some are by county, some are by state. So you got to be careful. Sometimes doing Roth conversions, if you intend on leaving this asset to your children, to beneficiaries, to a non-spouse, you may be able to do that and sidestep taxes, but you could be giving up some subsidies, and it could be healthcare subsidies. So you got to be careful. How old are you, tax bracket, etc. Okay, next question. This one says, I'm on a fixed income. Are Medicare costs going up again? Well, like anything else, I think the answer to that is basically yes. Like anything else, all right? So healthcare, yeah, inflation's hitting seniors as well. Standard Medicare Part B monthly premiums officially jumped to 10% or $202.90 a month, up from the previous baselines. Furthermore, the annual Part B deductible has increased to $283. When reviewing your fixed cash flow, obviously you want to ensure these premium deductions are properly factored into your baseline numbers. I can't stress this enough. Healthcare and the cost of your care in retirement is something that a lot of people don't think about or plan for. While I look at my normal living expenses, my mortgage will be paid off. I've got my healthcare supplement. I've got the cost of insurance for home and auto. I've got property taxes. I've got living expenses, utilities, food, travel. But they don't think about the cost of healthcare. You know, I think of taking care of your eyes, your teeth, and your ears. Hearing aids are massively expensive. Dentures, replacement, getting teeth pulled. I can tell you, we have clients that they have bills 10, 20,000 in retirement. So think about that. Vision too. Think about your eyes, taking care of your eyes, being able to see, being able to walk. Legs are a big one. If you're immobile, everything else starts to deteriorate. I had my car accident in December, and I can tell you, walking at times can be a challenge. I have some knee issues now resulting from that. So be careful about your health, not just with the cost of premiums and planning for that, but also exercise and diet. I can't stress it enough, and I should practice what I preach because even my own habits are falling to the wayside. So yes, to answer your question, the cost is going up just like anything else. And I can tell you, I wrote a blog on this a couple years ago. 10 to 15% increases a year. If I could have an investment that made 10 to 15%, I would choose that investment. Well, guess what? Premiums for healthcare have gone up traditionally about that rate. All right, next question. Is there a new tax break for seniors this year that can offset those costs? So it sounds like this is a follow-up. Yeah, there is a major silver lining, actually, when you bring this question up. Newly enacted federal tax provision was introduced, and we can deduct up to $6,000 specifically for individuals age 65 or older. The deduction is specifically engineered to reduce or completely get rid of, eliminate federal income tax liabilities on Social Security benefits or middle-income seniors. Make sure your CPA applies this in the new tax season. So I'm sure a lot of you folks that work with tax preparers, you want to make sure they're on the up and up. A lot of folks will use the library or some other free services for seniors. Make sure that they're aware of that and make sure that it gets applied. Our fifth and last question here. Everyone said inflation was beaten. Why do experts think it'll go back to 4% by the end of the year? Well, this is always a challenging one, right? So sometimes good news is bad news is good news, and vice versa for the stock market and investors. Easy deflationary wins are over. I think we saw that coming. Economists expect headline inflation to reaccelerate towards 4% due to two macro forces. Delayed economic pass-through of intensive new manufacturing tariffs. So tariffs are still in play, right? Persistent structural labor shortages in domestic service sectors. So I have a lot of business owners that are still looking to hire, right? I also meet with individuals who are looking for work. I don't know that the two necessarily cross paths. It might be, again, the focus on the type of work that's available and maybe less desirable. So that's something to think about. Wages being driven higher, which businesses pass through directly to consumers. So we're in a structural higher for longer environment with just about every single aspect you can imagine. So costs are not going down. I think the momentum still exists. I still think there are tons of opportunities for people to be invested in the market and continue with that path. I think we have to have some optimism, right? The foreign markets seem to be a bit challenged. They were off to a good start. But things like commodities as well. You look at like copper and all the things they're doing there with the data transfers. You look at stocks that are utilizing that. You know, I think of local companies like Corning Glass, right? Stock selection is only one of the things that we focus on, but it's it's part of a bigger plan is what it is. At the end of the day, I think that we have a lot of things to be cautious about We have two ongoing wars, Ukraine, and obviously the issues with the Strait and getting products through there. I think there's a bigger impact on Europe than there is here. But just about any business that we work with, you think about mid-size and large cap companies, are international companies now, right? There's no just domestic companies unless they're maybe a smaller mid-size. You think of like Coca-Cola, is that an international company? Well, think about all the different parts of the world they touch. Matter of fact, David, the birthday boy, we think about some of the conversations we've had, and he tells me that in Africa, in many places, it's much cheaper and more prevalent for people to be drinking Coca-Cola than water. Think about that for a minute. It's cheaper for them to buy Coke than water, purified, clean water. And that's some of the work that he does out there with wells. And again, I don't know if that's still the primary focus of what he does, the work that he does. That's one aspect. But companies now are international. They're a bigger part of the overall economy. I still think the tech sector and you think of semiconductors are a big part of what we're doing. This AI push in infrastructure, I think we're in the very early stage of things. They still have a lot of legs to grow and develop. I think the adoption rate is quite low. People are still trying to figure things out. And the development of AI itself changes so rapidly, day after day, month after month, exponentially. It brings about some other questions about cybersecurity and things that would take 8 to 10 years to do on the back end for criminals can now be expedited. So I think cybersecurity is going to be an area that we need to focus on as well. But I think all in all, that should give us kind of a 6-month, halfway through the year update on where things are. We've obviously come off of the lows on the market in March. Thankfully for those that stayed faithful and maintained their belief in the plan and understanding what we're trying to do here, not just for you as an individual investor, but on a bigger scale, and continuing down that path. I think, the old adage, sell and may go away. Well, that really hasn't worked out too well. You could have sold out in March and sat on the sidelines April, May, and really missed a big run up on the market. So stay healthy, stay cool. And I think that's all the time we have for today's show. Thanks again for listening to the Pennywise Financial Podcast. Constantine here at Monarch Wealth Management, signing off.
You've been listening to Pennywise Financial, brought to you by Monarch Wealth Management. Constantine and David really care about their clients. They want to make sure you're happy, so you'll continue to hire them. There's no commitments, and clients are free to leave whenever they want. Think about being able to pick up the phone and call someone for guidance and advice on almost anything, from buying a car, selling a home, buying vacation properties, or even selling a business. Reach out on the website at monarchwealthmanagement.com. There are 2 offices in Rochester and 2 offices in Buffalo. Reach out to us on Facebook, LinkedIn, Twitter, and YouTube, or call us toll-free at 800-480-1580. That's 800-480-1580. Until next time, this is Pennywise Financial, signing off.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA, and SIPC.